Imagine a massive commercial airliner. It's, fully boarded, just sitting out there on the tarmac at JFK. The engines are primed, the pilots are in their seats, but the plane literally cannot push back from the gate.
Right. They're completely stuck.
Exactly. And it's not because of a mechanical failure or like air traffic control. It's because a tiny, completely unglamorous printer bolted to the flight deck just jammed. And the crew can't print the physical, regulatory mandated weather manifest.
Which means nobody's going anywhere.
Yeah, nobody moves. And today, for you, the listener, we're going to look at these invisible, totally unglamorous bottlenecks of the global economy. Because when you think about the markets, you usually picture incredibly loud, flashy things.
Right? Absolutely. Like massive server farms powering AI or sleek rockets.
Right. Or Wall Street trading floors in a total frenzy.
Yeah.
But the reality is, if you pull back the curtain, the global economy actually runs on these quiet, almost invisible nuts and bolts.
It really is the ultimate contrast between perception and reality. I mean, what grabs the headlines almost never reflects what actually keeps the lights on.
Yeah. And nowhere is that contrast more violent than in the stack of sources we are looking at today. So let me set the scene for you. It's mid-April 2026. Earnings season is just kicking off.
A very busy time.
Insanely busy. And the financial reports we are deep diving into today are literally surrounded by a wall of high-stakes, chaotic market noise. The articles in our source stack are just plastered with screaming digital ads and headlines about an Iran war shock.
Right, alongside breaking news on U.S.-Iran ceasefire.
Exactly. You flip the page, and there are alerts warning about massive AI memory chip shortages, Palantir stock dropping after an Anthropic warning, SpaceX IPO rumors, and these intense flashing notifications about connections between Donald Trump, Mar-a-Lago, and Elon Musk's latest AI ventures.
Yeah, and I should interject here really quickly just to impartially report on that context, because these sources contain highly politically charged ads and headlines from, well, both left-wing and right-wing perspectives.
Very true. And we need to explicitly state to you, the listener, that neither of us is endorsing any of these geopolitical or political viewpoints. We are simply conveying the chaotic, high-stakes information environment in which today's focal company is operating. Exactly. That is the water the market is swimming in right now. Complete sensory overload. But our mission today is to cut right through that AI and geopolitical noise.
We're zooming way in.
Way in. On one specific document buried in that madness. It's the Q4 2026 earnings report for a company called AstroNova, trading on the NASDAQ Q under the ticker a lot. Okay, let's unpack this. What does a foundational reset actually look like for a company making, well, the kind of mission-critical hardware nobody thinks about until it breaks?
Yeah, to really grasp what a reset means for them, we first have to understand the DNA of AstroNova. And you are right, it is a stark departure from the Silicon Valley headlines.
They're definitely not a trendy AI startup.
No, not at all. Their heritage goes all the way back to West Warwick, Rhode Island. They originally started out building these highly specialized, ruggedized oscillographs for industrial clients.
I have to admit, an oscillograph sounds like a piece of equipment you'd kind of bolted to the wall of like a Cold War submarine.
That's actually not too far off, at least in terms of durability. It's essentially a device used to measure and record electrical vibrations and waveforms, but specifically designed to operate in extremely harsh environments. They build a reputation on making things that do not break when you vibrate them, freeze them, or just drop them.
Right.
And that specific DNA building tough, reliable things for difficult conditions eventually evolved into what they call precision graphic communications.
So they basically went from measuring vibrations to printing data under duress.
Essentially, yes. Today, they operate two main arms. First, you have product identification, which focuses on digital color label printers and packaging solutions for industrial use.
Got it.
And second, you have aerospace, which makes those highly specialized printers designed for the flight decks of commercial and military airplanes.
I like to call this the invisible nervous system of commerce. Because, investors right now are obsessively tracking the latest AI microchips. But think about the real world for a second.
Oh, exactly.
If a hospital pharmacy cannot print a highly specific, regulatory compliant label for an IV fluid bag, that bag legally cannot be administered to a patient.
Right.
Or if a chemical plant can't print a warning label that survives a highly corrosive environment, that barrel of chemicals literally cannot be shipped. The whole system grinds to an absolute halt without this specific hardware.
It really does.
But help us understand the business model here. Why is this seemingly boring, basic technology actually a highly lucrative space?
What's fascinating here is the concept of stickiness. These are not just fun stickers you print out for a neighborhood bake sale.
Definitely not.
AstroNova's equipment is deeply embedded in heavily regulated workflows. Think life sciences, industrial chemicals. In a chemical plant, for instance, a label must withstand extreme environments and meet strict regulatory standards.
So it's not just the paper, right?
No, it's the ink itself, the materials. Everything has to be chemically formulated to meet these strict, constantly updating government regulations.
Oh, so if you're the plant manager, once you integrate a printer that successfully passes all those brutal compliance audits, you aren't going to swap it out just to save like $50 on a competitor's machine.
Never. The switching costs are effectively prohibitive.
Because from a regulatory and risk management standpoint, the hassle is just astronomically high.
Exactly. The more annoying and tedious a government regulation is, the more profitable it is for the obscure company that provides the hardware to prove you followed it. You become a permanent part of your customer's risk management system.
Man, compliance is a moat. That is a brilliant way to look at it. So they've built this massive regulatory moat in their product identification division. But, a moat only works if you actually defend it and capitalize on it.
Right, which brings us to the actual performance.
Right. Fiscal 2026 was framed by their CEO, Jorg Ittman, as a foundational reset year, specifically for this division. And I'm looking at the data he presented, and he is super enthusiastic about it.
He is. And we should look at that granular data because it paints a picture of a turnaround gaining momentum. Second half sales for Product ID were up 4.2% compared to the first half.
Okay.
And their Q4 orders hit $27.5 million. That's a $2.9 million year-over-year increase, pushing the book-to-bill ratio to 104%.
Just to make sure we're on the same page, a book-to-bill ratio over 100% simply means they're booking new orders faster than they are billing and shipping the old ones, right?
Correct. The pipeline is expanding.
But, okay, I have to push back here. A 4.2% sales increase is nice. But we're in a market where some tech companies are literally doubling their revenue. Why is management calling a modest single-digit bump a foundational reset? That phrase implies some massive structural overhaul. What actually changed under the hood?
It's the right question to ask, because the reset wasn't just about selling more printers, it was about where they are selling them. They didn't just try a new marketing campaign.
Okay, so what did they do?
According to the transcript, they applied robust analytics to figure out exactly where their value proposition is strongest. By focusing sales resources strictly on life science, industrial, and chemical verticals, they stopped chasing bad leads.
Oh, I see. They realized not all revenue is good revenue.
Precisely. They focused entirely on those long sales cycles. And yes, it takes longer to get a hospital to approve new hardware, but that results in incredible customer retention,
Right.
upgrades, and most importantly, a highly profitable aftermarket business, which represents about 80% of segment sales.
Ah, the ink.
The ink, the specialized thermal labels, the maintenance contracts, it's the classic razor and blades business model, but for industrial compliance.
You buy the printer once, but you are locked into buying their specialized ink forever. Okay, that makes perfect sense. So that's the factory floor. Let's transition our focus a bit.
To the skies.
Right, to the aerospace segment. Because if Product ID is a story about regulatory stickiness, aerospace seems to be about outright market dominance.
It's a completely different dynamic. This is about capturing share as global build rates recover.
Looking at the transcript, the dominance of their ToughWriter product family is just wild. It now represents more than 80% of their total flight deck printer shipments. That means if you walk onto almost any modern commercial jet, the printer staring back at the pilots is made by AstroNova.
It's a massive footprint.
And the orders reflect that. Aerospace orders for the quarter hit $13.6 million, with a staggering book-to-bill ratio of 122%.
If we connect this to the bigger picture, you really have to look at the trailing backlog. The aerospace backlog is actually up 17.6% to $12 million.
Okay, wow.
Now, I have to point out the nature of aerospace demand here. It's notoriously lumpy.
Lumpy meaning, like, unpredictable.
Meaning it doesn't flow in a smooth, straight line. It is entirely subject to original equipment manufacturer project timing. So Boeing or Airbus schedules.
Wow, got it.
If an OEM delays a plane build by 2 months waiting on a different part, AstroNova can't ship their printer. So quarter-to-quarter variations often mask the underlying steady recovery.
It's essentially a massive supply chain traffic jam. The demand is there, they're just waiting for the highway to clear. But here's where it gets really interesting. Buried in this discussion, there's a detail about an upcoming catalyst, A major royalty obligation is expiring in the third quarter of fiscal 2027.
Yes, this is a crucial mechanical detail.
Right.
When building complex aerospace hardware, companies often license patented technology, paying a royalty fee on every unit.
Right, a legal obligation.
AstroNova has been paying one for years, but that legal obligation officially expires in Q3 of fiscal 2027.
I love when we find these structural financial mechanics. It's like a literal toll booth. For a decade, every time they shipped a printer, they handed over a cut of the profit. In Q3 of 2027, that toll booth is being permanently demolished. They just automatically get to keep the toll money.
And the math is very compelling.
What does that mean in actual dollars?
This expiration yields an estimated $2 million annualized benefit to their gross profit. And because it's a fixed cost removal, that $2 million is effectively a pure gross profit drop-through. It goes straight to the bottom line starting in Q4 of 2027.
For a company doing about $150 million in total annual revenue, recovering $2 million in pure profit margin without lifting a finger that is massive, it's found money.
Which is exactly what investors look for in a stabilizing company.
Okay, so we've established the narratives. Product ID is leaning into a highly profitable razor and blades model. Aerospace is dominating the flight deck with a massive backlog and a $2 million windfall coming.
The operational story sounds fantastic.
It does, but now we have to do the financial reality check. Do the actual numbers support this amazing story? Because the scorecard for Q4 is a very messy, mixed bag.
The balance sheet always tells the unvarnished truth.
So it's the morning of April 14th. The stock price sits around $11.50, down about 1.87% for the day. And here's the paradox. AstroNova massively beat expected revenue. They pulled in $37.54 million against an expectation of $29.19 million.
A huge beat.
Over $8 million. Yet they simultaneously missed the earnings per share consensus. They reported an actual EPS of -4 cents against an expected positive 4 cents. Furthermore, their gross margins contracted 250 to 260 basis points year over year down to 30.2%.
Which naturally raises massive alarm bells.
I mean, yeah, I have to push back on this whole foundational reset victory lap. First of all, 250 to 260 basis points. In plain English, what is that?
It's just the financial industry's way of saying 2.5 to 2.6%. Their profit margins shrank by about 2.5%.
Okay, but if they beat revenue expectations by over $8 million and they have all this great momentum, how on earth did they lose money this quarter? Where is the leak in the ship?
To understand that, we look at what CFO Tom DeBile explains as a shift in product mix. It sounds illogical, but it happens if you sell a high volume of really expensive, low-margin legacy machines, but you fail to sell the high-margin items.
Wait, let me make sure I'm getting this. So the factory was super busy shipping these complex hardware printers. Revenue spikes by $8 million. But because they take so much labor to build, the actual profit is tiny.
Exactly.
Meanwhile, the Golden Goose, the highly profitable ink and label aftermarket, had a slower quarter.
That is precisely what happened. The volume of the profitable stuff went down relative to the unprofitable stuff. It creates a massive top-line beat, but an earnings miss. But DeBile also points out we shouldn't look at straight year-over-year comparisons here anyway.
Why is the comparison broken?
Because last year's fourth quarter included a massive $13.4 million goodwill impairment. It totally skews the baseline.
Goodwill impairment. Does that just mean they overpaid for an acquisition years ago and accounting rules finally forced them to write off the loss?
That is pretty much exactly it. It's a paper loss, not actual cash going out the door today. When you strip that away, they actually generated $1.3 million in operating profit in the second half of the year compared to a first half loss.
So they stopped the bleeding.
They did. And they generated $11.7 million in operating cash for the year. They used that to aggressively slash their debt down to $37.6 million, putting their net leverage at a very healthy 2.97.
Okay, so the structural integrity of the company is getting much stronger. The leak was mostly historical baggage and a weird quarterly product mix.
Yes, exactly.
But that brings us to the absolute bombshell waiting at the end of this report. The board of directors is actively evaluating strategic alternatives.
Which is the ultimate corporate speak phrase.
Right. Translate that for us. What does evaluating strategic alternatives actually mean?
It means putting a giant for sale sign on the front lawn. It could entail a potential sale of all or part of the company, a strategic investment, or a merger.
But why do that now? The reset is finally gaining traction. Why put up a for sale sign right when things are getting good.
Because management likely believes the public markets might not be adequately valuing the turnaround they just engineered. If you've streamlined the business and have a $2 million windfall coming, you've made yourself a highly attractive target.
Oh, I see. They think a private equity firm will pay a massive premium today rather than waiting for the public market to slowly bid the stock up over the next 3 years.
Exactly. It's like flipping a house right after you fix the foundation.
So what does this all mean? When we zoom out, the core takeaway for you, the listener, brings us right back to that commercial airliner stuck at the gate. The rest of the market is chasing SpaceX IPO rumors and AI chips.
They're all looking up.
Right. But companies like AstroNova are quietly operating down in the trenches, doing the capital-light, foundational work that keeps the world compliant and operational.
And it leaves us with a fascinating final thought. If a foundational reset works perfectly, if you clean up your backlog, streamline operations, and prepare for a $2 million royalty windfall, do you actually get to enjoy the organic growth as an independent public company?
That's the real question.
Or does making yourself a highly efficient machine simply make you the perfect acquisition target for a much bigger player?
It's the ultimate irony of business. Thank you so much for joining us on this deep dive into the sources today. We hope this encourages you to keep looking beneath those incredibly noisy headlines. Until next time.